The importance of liquidity in financial markets. Liquidity is a crucial aspect of financial markets that determines the ease with which an asset can be bought or sold without causing significant price movements. It refers to the degree to which an asset can be converted into cash quickly, efficiently, and at a fair price. In this article, we will explore the concept of liquidity in financial markets, its significance, and its impact on various market participants. Understanding liquidity. Liquidity is a measure of how easily an asset can be converted into cash without affecting its price significantly. It reflects the depth and breadth of a market, indicating the ability to buy or sell large quantities of an asset without causing substantial price changes. Highly liquid assets are characterized by a large number of active buyers and sellers, low bid, ask spreads, and minimal price slippage. Key factors affecting liquidity. Several factors influence the liquidity of a financial market. These include trading volume, market depth, bid, ask spreads, transaction costs, regulatory environment, market structure, and investor behavior. Higher trading volumes, narrower bid, ask spreads, and lower transaction costs generally indicate greater liquidity. The significance of liquidity. Liquidity plays a vital role in financial markets for several reasons. Firstly, it enhances market efficiency by ensuring the smooth functioning of price discovery mechanisms. Secondly, it provides market participants with the ability to enter and exit positions promptly, reducing the risk of being unable to sell or buy an asset when needed. Thirdly, it fosters investor confidence, attracting more participants and increasing market liquidity further. Liquidity and market efficiency. Liquidity is closely linked to market efficiency. In highly liquid markets, prices accurately reflect available information, ensuring fair and efficient transactions. Market participants can quickly obtain the best prices for their trades, which leads to tighter spreads and reduces the impact of market inefficiencies. Implications for investors. For investors, liquidity is an essential consideration when selecting assets. Highly liquid assets offer the advantage of easy entry and exit, enabling investors to adjust their portfolios efficiently. Additionally, liquidity also affects investment performance, as lower liquidity assets tend to be associated with higher transaction costs, increased price volatility, and potential slippage. Liquidity risk and management. Liquidity risk refers to the possibility of not being able to execute trades in a timely manner or at a fair price due to insufficient market liquidity. Financial institutions, such as banks and investment firms, actively manage liquidity risk to ensure their ability to meet financial obligations and honor withdrawal requests from clients. Liquidity risk management involves maintaining adequate liquid assets, diversifying funding sources and stress, testing liquidity positions. Central banks' role in maintaining liquidity. Central banks play a vital role in maintaining liquidity in financial markets. They act as lenders of last resort, providing liquidity to banks during times of financial stress to prevent systemic failures and stabilize the overall financial system. Central banks achieve this by implementing monetary policy tools such as open market operations, discount window lending, and reserve requirements. The relationship between liquidity and volatility. Liquidity and volatility are interconnected in financial markets. When liquidity is low, even a small influx of buying or selling pressure can result in significant price movements, leading to higher volatility. On the other hand, high liquidity tends to dampen volatility as market participants can easily absorb large buy or sell orders without causing drastic price changes. Understanding the relationship between liquidity and volatility is crucial for market participants to manage risk effectively. Liquidity in different financial markets. Liquidity varies across different financial markets. For example, the foreign exchange market is known for its high liquidity due to its decentralized nature and large number of market participants. Similarly, major stock exchanges like the New York Stock Exchange, NYSE, and NASDAQ exhibit high liquidity driven by the constant flow of buyers and sellers. However, other markets such as the bond market or smaller regional stock exchanges may have lower liquidity levels. Challenges in measuring liquidity. Measuring liquidity accurately can be challenging due to its multifaceted nature. Traditional metrics like trading volume and bid, ask spreads provide some insights, but they do not capture the complete picture. Other measures, such as market depth, order book analysis, and price impact analysis, are used to assess liquidity in more detail. However, market participants and regulators continually seek improved methods to measure and monitor liquidity accurately. Liquidity and market crises. During periods of market crises or economic downturns, liquidity can evaporate rapidly, leading to severe disruptions. This was evident during the global financial crisis of 2008, where liquidity dried up in several key markets, causing financial institutions to struggle and exacerbating the overall economic downturn. Central banks and regulatory authorities have since implemented measures to enhance liquidity, resilience, and mitigate the impact of future crises. Strategies for enhancing liquidity. Market participants employ various strategies to enhance liquidity. High-frequency trading (FTU). Firms utilize sophisticated algorithms to provide liquidity by executing a large number of trades in milliseconds. Market makers also play a crucial role by offering continuous bid and ask prices, ensuring a ready supply of liquidity. Additionally, electronic trading platforms and advancements in technology have improved market access and execution speed, contributing to overall liquidity enhancement. Regulatory framework for liquidity management. Regulators have established frameworks to ensure effective liquidity management in financial markets. Banks and financial institutions are required to maintain adequate levels of liquid assets, such as cash or highly liquid securities, to meet short-term obligations. Regulatory stress tests assess institutions' ability to withstand liquidity shocks, ensuring the stability of the financial system. Additionally, transparency requirements and reporting standards help monitor and manage liquidity risks effectively. Future trends in liquidity management. The landscape of liquidity management continues to evolve as financial markets and technology advance. The rise of digital assets and blockchain technology introduces new possibilities for liquidity provision and trading. Decentralized finance. DeFi. Platforms are gaining popularity, offering innovative liquidity solutions through automated market-making protocols and liquidity pools. As market dynamics change, market participants and regulators will need to adapt to ensure efficient and resilient liquidity management. Conclusion. Liquidity is a critical element in financial markets, enabling smooth and efficient trading while promoting market stability. Understanding the factors that affect liquidity, its significance for various market participants, and the challenges involved in measuring and managing liquidity are essential for investors, regulators, and financial institutions. By prioritizing liquidity management, market participants can mitigate risks, enhance market efficiency, and promote the overall health of the financial system. Frequently asked questions. Why is liquidity important in financial markets? Liquidity is important in financial markets because it ensures the smooth functioning of buying and selling assets. It enhances market efficiency, provides flexibility for investors to enter or exit positions, and fosters investor confidence. How does liquidity affect investment performance? Liquidity can impact investment performance as lower liquidity assets tend to have higher transaction costs, increased price volatility, and potential slippage. Highly liquid assets offer easier portfolio adjustments and better execution of trade. What is liquidity risk? Liquidity risk refers to the possibility of not being able to execute trades in a timely manner or at a fair price due to insufficient market liquidity. It is a concern for financial institutions and investors, and it is actively managed to ensure financial stability. How do central banks maintain liquidity? Central banks maintain liquidity by acting as lenders of last resort, providing liquidity to banks during times of financial stress. They use tools such as open market operations, discount window lending, and reserve requirements to stabilize the financial system. How do regulatory frameworks address liquidity management? Regulatory frameworks require financial institutions to maintain adequate levels of liquid assets and undergo stress tests to assess their ability to withstand liquidity shocks. Transparency requirements and reporting standards also help monitor and manage liquidity risks effectively.